Okay, hi everybody. It is 2 o'clock. Today is Wednesday the 22nd. And today we're going to be going through our webinar, How to Minimize Your Tax Filing Stress for the Upcoming Tax Season. Before we get started, I do have some housekeeping items to go over with everybody. Our webinar will be recorded and a link will be sent to everybody in about a day or two, along with a copy of the slide deck and any other relevant handouts and links. Please post your questions in the Q&A box, not the chat box. The Q&A box will create a log of your questions and then we can follow up with you after the webinar if we're not able to address any of the questions that you may have. And speaking of questions, please remember to keep your questions more general in nature. It's very difficult to address specific questions based on your facts and circumstances on a Q&A box. Those specific questions can be sent to us later and we can talk through those one-to-one. Okay, so this is me. I'm Michigan Santa of the Wolf Group. I'm a partner here. I'm an attorney by trade, and so you can see I've got my JD from Seattle University, my LLM from Boston University. Formerly served as an attorney with the IRS Office of Chief Counsel, Large Business International. I have my bar certifications in the states of Washington, Texas, DC, and the U.S. Tax Court. And I speak regularly at professional events sponsored by attorneys and CPA groups in the US and abroad. Okay, we're going to go ahead and kick off real quick so we can get started. There's a lot here to go over for the upcoming filing season. The first thing that I kind of want to get into is the last clause of the second sentence from our welcome letter from Len Wolf, the original owner of the Wolf Group. He talks about ongoing changes and adjustments from the tax laws that were enacted in 2017. This is critically important to understand as a layer for everything that we're going to be talking about. And just as a reminder to everybody, the Tax Cuts and Jobs Act was passed at the very end of 2017. And we now know that the writers of the bill basically started writing the legislation in September of 2017, proposed the legislation in November of 2017, and then eventually passed legislation in mid-December of 2017. You know, that's a very short time span, if you think about it, to pass a major tax overhaul. And you talk about 6 weeks of kind of going back and forth in Congress on finalizing the bill is also a very short time. If we look back to the last tax code that was passed, which was in 1986, that one took 56 weeks of going back and forth in Congress and negotiating and thinking through how all those changes would affect the tax code. So 6 weeks versus 56 weeks will always lead to adjustments and ongoing changes that will be needed on a go-forward basis. And then the last thing that kind of comes out of that is what we call state conformity. A lot of the states have had to make a determination if they're going to conform to the federal rules or not. And in particular, the states on the East Coast and West Coast, there's some detrimental changes to them on the federal code that they've had to deal with. And so Virginia, for example, has finally got their act together and put forth some new rules that will apply for 2019, which we'll talk about. But you should look specifically at your state to see whether they've conformed to the federal code or they've deconformed. And if they've deconformed, what are the differences between that state's tax law and the federal code? Okay, so one of the first things I'd like to relay is this tax calendar that I put together for everybody. And I think it's critically important for everyone to understand these specific due dates. We get these questions occasionally on when are the forms due, what's the activity within the Wolf Group. And as you can clearly see, this tax calendar kind of walks you through the entire calendar year. I'll flip to the second slide here. But most of the activity centers around the magical date of April 15th, which this year is April 15th, 2020. And you can see that a lot of different forms are due to the IRS by that date. So you have the individual return, you've got the domestic gift tax return, you've got the foreign gift tax return, you've got the FBAR, trust and estate returns. Those are all due by April 15th. One of the big things that I think always creates a little bit of confusion, both for the client and for the firm, are people that are making extension payments and estimated payments right around April 15th. And I want to make sure that people understand that if you're going to make an extension payment on or before April 15th, and you're also going to be making that first quarter estimated tax payment, you just want to make sure that you clearly notate that both on your payments and in the documentation that you give to the firm so that there's no confusion as to which payment goes where. If that's not notated correctly or understood correctly, it can create havoc for 2 different tax years. And so we definitely want to make sure that we get that right. The second part of the calendar here, I think, really deals with a lot of dates that most people forget about in the latter half of the year. But just to keep on everyone's radar, when the second quarterly payment voucher is due, the due date for non-resident aliens, which is June 15th, and then the extension due dates, which occur in September, October, and then for certain individuals that live offshore that need additional time under the foreign earned income exclusion, you have until December 15th. Dovetailed with that are the extension forms. These are critically important. I always tell people that you always want to confirm that the form has been either e-filed or paper filed for you. Make sure that you follow up with your CPA or your tax firm to make sure that that's actually gotten in and you have a confirmation. So for individuals or folks filing the Form 3520, you definitely want to make sure the 4868 was filed on or before April 15th. For those folks that have foreign grantor trusts, which a lot of folks I know have foreign pensions classified as foreign grantor trusts, it's the 7004 extension form, which can only be e-filed if you have an EIN. So that's another big one that I think I would like to raise and make sure that people are aware of. But these are the general types of extensions that we regularly file for our clients here at the Wolf Group. Okay, if it's one thing that I learned at the Internal Revenue Service, one thing that they hammered home to me that I could pass on to you is what we call the golden rule for tax, which deals with extensions. And to make clear, an extension is an extension of time to file a tax return or international informational report. It is not an extension of time to pay taxes that are due. So all of your taxes are due by April 15th. The extension will just help you avoid the failure to file penalty, which is actually a very big penalty because it's based on the amount that you have due. So also to understand that there are penalties for not paying timely. You have the failure to pay penalty for what you report on the tax return. You have a failure to pay penalty for what's not reported on a tax return. And then a common penalty that a lot of people get because they're not doing their estimated taxes correctly is the failure to pay proper estimated taxes. So be real careful with how you're doing your extensions and how you're thinking about your payments, because if you do it the wrong way, you may get hit with one of these penalties. I'm going to pause for a second as we do our first polling question. And if there's any chats on here, please let me know. If there's any questions on here, please let me know. So the question is, what schedule on IRS Form 1040 has informational related questions about cryptocurrency? And I don't think we've actually talked about that yet. That's going to be 2 from now, but let's see if people can guess what that one is. Okay, we have a lot of people voting here. That's very good. Interesting. Okay. Let's go ahead and, yes, so the poll is overwhelmingly Schedule 1, and we will get to that here in a minute. And we'll talk through, let's go ahead and we'll go on to the next slide here, which is the 2019 1040 form, the brand new one for 2019. So back in 2017, when I was talking to different Congress folks about the 2018 tax return, one of the big things that they showed me or they talked to me about was the fact that they were going to make a postcard. And in particular, I had a lengthy conversation with Ted Cruz on this, and he said, you know, we're going to slash 50 line items from the 1040 and we're going to make it look like a postcard and it's going to be super easy. And I kept asking him, I said, you know, slashing 50 line items, that's a big deal. Where, you know, you can't just consolidate all of those or do away with them. So what exactly are you going to do with those 50 line items? Well, it turns out that they moved all 56, there's total 56 line items into what are called Schedules 1 through 6. And they asked for comments about this new format, and the IRS received over 500 comments from practitioners primarily. But they were overwhelmingly, according to the report, overwhelmingly unfavorable comments. People were having a very difficult time at finding out how everything tied out. You know, under the old tax return, you could look at page 1 and page 2. It was very easy to track how everything looked. You could follow the math. Under the 2018 return, you almost had to lay out all the schedules with the tax return. and kind of make sure that it all flowed correctly. So it created a lot more review, and it's very difficult to follow the math. And in addition, if you look at the size of the 2018 and 2019 returns, it's just as big as the 2017 return. So it really hasn't changed. So what has the IRS done now? So in 2019, they've said, look, we've got your comments. We see that's overwhelmingly unfavorable. We're going to go to a different format. So the 2019 return is going to look different from 2018. It's going to look different from 2017. It's got its own format. Instead of 6 schedules, there's going to be 3 schedules. Okay, so Schedule 1, Schedule 2, Schedule 3. And what they've done is they've taken the 6 schedules and just consolidated it down to 3 schedules. They've also moved some things around. So if you look on the slide, you'll see that capital gains are now back into the tax return on line 6. And the qualified business income deduction is now on line 10. And lastly, they've removed the question about health insurance coverage because there's no longer a tax penalty for 2019. Let's move on to the next slide. Okay, so this is what the polling question just talked about. And in specific, Schedule 1 has now changed significantly on a couple of items. The first is the informational question related to cryptocurrency or virtual currency, which you'll see I've highlighted there at the top of Schedule 1. I recently asked this question to IRS Chief Counsel. I said, you know, you're kind of hiding the question in there, and it's a little ambiguous. I don't know if I gave that question to a lot of my clients that have cryptocurrency, if they would be able to accurately answer that question, even though it's a yes or no question. And I made a comment that perhaps what they should do, because they also have questions related to the FBAR, and as you'll see, we have other questions as well. Perhaps what the IRS should do, since they're big on these new additional schedules, is just create a schedule, call it information, and put any question that they'd like a taxpayer to answer on that one schedule. Make it really overt in big font, make it to where you can't submit a return without answering those questions. And that way, and make them super clear. Don't make a 3-part question into a 1 question. You know, really make it super clear. And I think that will go over better. But just to note, if you have cryptocurrency holdings, you do need to answer this question on Schedule 1. And as we've seen with the FBAR questions, failure to answer it properly could lead to big liability. That's how they get a lot of people on being willful or non-willful. It's how did you answer those questions on Schedule B, Part 3. The other change to the form, or excuse me, to the schedule, is the questions, as you can see, that I've highlighted in regards to alimony. And it's this inclusion of the date of original divorce or separation agreement. So you have to fill that in to make sure that you're in alignment if you are either including alimony or deducting alimony that you pay. That's part of the new tax code, and that particular piece of legislation went into effect on Jan 1, 2019. Speaking of cryptocurrency, just one thing to highlight here for those folks that do have cryptocurrency, because the IRS has put out a lot of guidance on this recently. Cryptocurrency folks can basically be broken down into 1 of 4 categories: investors, miners, dealers, or traders. And depending on which category you fall into, you need to be aware of all the different items that apply to you. We have a special section of our questionnaire that we require anyone that has cryptocurrency to answer, which I've highlighted here on the right-hand side. Make sure if you do have cryptocurrency and you fall into one of these categories that you do answer the questions and provide the background information so that we can properly report any income or holdings you have to the Internal Revenue Service. And lastly, for those folks that have cryptocurrency in foreign or offshore exchanges, that still needs to be reported on Form 8938. The IRS has kind of, I should say FinCEN, has indicated that's no longer required on the FBAR, but the IRS is still ambiguous as to whether or not that is reported on the 8938. So the conservative approach is go ahead and report it. Okay. Schedule 2. Schedule 2 has now changed a little bit. What has happened is that it has taken all of Schedule 4 and incorporated it into Schedule 2. So you'll see that there are a lot more items that are on Schedule 2 that used to be on Schedule 4. On this schedule, the one item that I will highlight is the transition tax, and there's a misspelling in the slide, it should be transition tax, which is line 9, which is your 965 tax. So for those individuals that had controlled foreign corporations and were hit with the transition tax in 2017, you may be paying your liability through installment payments, and the IRS just wants you to make sure that you're properly reporting that. on line 9. Schedule 3 deals with credits and payments. That particular one used to be bifurcated on Schedule 3 and Schedule 5. So now we have those all together on one schedule. And I've highlighted the areas that most people probably have to deal with. So you have your foreign tax credits that are reported on line 1 of Schedule 3. You've got your child and dependent care credits on line 2 of Schedule 3. The estimated tax payments that you've made throughout the calendar year and any amounts applied from 2018 will go on line 8. And the amounts that you pay with your tax return for an extension go on line 10. So when you're doing your due diligence and you're looking over your tax return to verify that all the amounts are properly in there, these are some generally used items that you might want to double check just to make sure they're recorded properly. Okay, let's go to our second poll now, and we'll walk through that for a minute. So looks like we're back on to the cryptocurrency question, which I think we all know the answer to that one. That's right. There should be no one answering any of the other schedules. Okay, looks like yes, it is Schedule 1. So just to reinforce that again, Schedule 1 is where you want to answer the yes or no question related to cryptocurrency. Okay, so let's move on. Schedule D. Schedule D has now changed a little bit. Here's another informational question that goes back to my original comments about reporting of information. It's did you dispose of an investment in a qualified opportunity fund during the tax year? Well, what does that mean? That is talking about qualified opportunity zones. And so what are qualified opportunity zones? Qualified opportunity zones, if we go to the next question, qualified opportunity zones were part of the Tax Cuts and Jobs Act. They are in all 50 states and in several territories. They're basically distressed areas where new investments, can really help that area grow and flourish and rebound. And it's areas that we want to improve our infrastructure and investments. The original concept was more along the lines of improving, our roads and bridges and all that stuff. But most of the stuff we're seeing for qualified opportunity zones really relates to real estate and real property and kind of updating those things. So what the offer is basically if you have a large capital gain and you don't want to pay tax on that and you're okay with investing that gain into a qualified opportunity zone, the IRS allows you to defer the tax on that gain in the current year. You then can avoid up to 15% of the actual tax due if you hold that investment in the qualified opportunity zone for up to 7 years. And then any gain on the investment in the qualified opportunity zone during the entire holding period, if you hold it for 10 years or longer, gets a step up in year 10. So your return on investment within the qualified opportunity zone can come back to you tax-free. A couple comments here. First off, this is a long-term play. So as you can see, to really maximize the benefit, you've got to hold your qualified opportunity zone investment for 10 years. That's quite a long time. So just understand that you may have any investment you put in there, wrapped up for a long period of time. The second comment is that the qualified opportunity zone investment, the capital gain, is a worldwide capital gain. So if I sell a foreign real property or if I have some kind of foreign capital gain, I can actually defer that gain by using the qualified opportunity zone. The same thing holds with cryptocurrency. If I have a large gain of cryptocurrency, I can defer that gain into the qualified opportunity zone as well. The last thing to note, and it's just to go back to the previous slide, is that if you are going to invest in a cryptocurrency, or a qualified opportunity zone, you do need to make sure that you answer this question properly. And then the reporting actually goes on the 8949, which is attached to Schedule D. There's a special way that you have to code the deferral of the taxation. So you probably want to make sure that you work with a CPA firm to do that if that's something that you want to entertain. Okay, the next slide here relates to the qualified business income deduction. As a refresher, the qualified business income deduction is a way to harmonize pass-through entities such as partnerships, S corporations, and individuals that are making self-employment income or sole proprietors. It's a way to harmonize their taxation against the 21% corporate flat rate that we now have. So if done correctly, you can get up to a 20% deduction off of your qualified business income, which again, typically flows through either on Schedule C as sole proprietor self-employment income, or through Schedule E Part 2. If you're a partner or an owner in an S corporation, you'll get a K-1, and you can qualify for that deduction. Last year, there was a sheet that you had to fill out to show the math on how you came to your deduction. This year, they're actually introducing 2 new forms that you'll have to complete to make sure that you properly qualify for the deduction. So on the left-hand side, you'll see that the simplified form, or the easier form, is going to be the $89.95. And that's for people that fall into a certain taxable income range, as I've indicated here, for single and married filing joint. If your income is over those amounts, you'll need to do a more thorough kind of analysis, and that's where the Form 8995A comes into play. So those are the lines of demarcation for how and when you'll use those forms if you do have the qualified business income deduction applicable to you in 2019. Moving on, the standard deduction has increased slightly. So as you can see, in 2018, if you were married, the standard deduction was $24,000. In 2019, the standard deduction is $24,400. Okay, so this chart kind of helps walk you through the differences in the standard deduction. Itemized deductions. Itemized deductions are going to be super interesting for 2019, especially depending on the state that you live in, and we'll get more into that. I believe someone has asked a question about the itemized deductions for Virginia, and we'll go into that here shortly. But I sent this picture out to a lot of my clients that were asking about itemized deductions after the new Tax Cuts and Jobs Act was introduced, so that they could understand what has changed in regards to itemized deductions. And really what you have here are 8 different changes that are occurring throughout the form. So you have the floor for, the ceiling for medical and dental expenses that is now at 7.5%. You have in the next section, which is the taxes paid or cap, there's a cap or SALT limitation, state and local tax limitation of $10,000 that's being implemented. You have mortgage indebtedness that has a limitation now in that next section for the interest you pay. You have gifts to charity, which now has a higher rate of deduction. You have a change to the casualty and theft losses, which now only applies for federal disaster areas. You have a complete removal of the 2% floor, which is that next section, which is number 7, which used to include your tax preparation fees, your wealth management fees, unreimbursed employee expenses, things like that. And then, of course, the last section there related to the limitation of itemized deductions is now gone. So in 2019, it's pretty much the same as 2018. So the ceiling, and it should say ceiling, stays at 75%. The limitations for SALT are $10,000 for MFJ and $5,000 for married filing separately. The home mortgage interest deduction is deductible up to $750,000. 60% is the limit for charitable contributions, and the casualty and theft losses and the floor deductions are no longer applicable. Okay, just looking at the questions that are being asked here, see if there's anything in particular we want to go through. Tax brackets. Tax brackets are super interesting for 2018 moving forward, and they have changed slightly. What I always like to tell clients, though, is that the battle is pretty much in the middle there, which is, if you look on the second column, which is the 24% to 32% jump right there. So you can see that if I'm at taxable income, if I'm single and I'm at taxable income of less than $157,500, I stay within the 24% bracket. I jump over that, though, I move up a lot. I move up to 32%, okay? So this is where planning on the brackets normally occurs, is going to be this area right here and the jump between the 24 to the 32. And the same thing applies for those of us that are married. You have the 24 to 32% jump, which is that in 2018, the line of demarcation there was $315,000. And in 2019, the line of demarcation is $321,450. The capital gains tax brackets have not changed very much. They increase slightly every year. So as you can see, if I was married filing joint in 2018, the cutoff is $77,400 before I start getting into the taxable brackets, whereas in 2019, it's $78,750. The one thing that I always like to alert clients to, or make sure the clients understand, is that if you get into that high bracket, 20% bracket, the Obamacare taxes, which are the Affordable Care Act taxes, still apply. So it's the 3.8% will kick in as well. So you could be at 23.8% for the highest capital gains tax bracket. That would also invoke Form 8960, which is that additional reporting for the 3.8%. Okay, let's see if we can get to another polling question to see if we can make that work. Okay, so what is the state tax deduction limit on Form 1040, Schedule A for couples married filing jointly? $5,000, $10,000, $15,000, or unlimited? All right, we've got a lot of good responses here. And it looks like overwhelmingly people are saying $10,000. And that is correct. So married filing jointly, the state tax deduction limit or SALT limit on Form 1040 Schedule A is going to be $10,000. Moving on to the child tax credit, which is now kind of has replaced. Back in 2017, we used to have the personal exemptions available to folks. And in lieu of doing away with those exemptions, you now have a beefed up child tax credit, which is $2,000 per qualifying child, $1,400 of which is a refundable credit, and a $500 credit for other dependents. A lot of people, when this was passed, called this the Ivanka Trump credit because she was the one that advocated for the higher credit. And as you can see, the higher phase outs as well. She wanted to make sure that it applied to people with higher income. So for single folks, it phases out at $200,000, and for married filing joint, it phases out at $400,000. The next slide here is the foreign earned income exclusions. So for those folks that are offshore, the primary mechanisms that can help you reduce or avoid double taxation or lower your tax due to the IRS will be the foreign earned income exclusion and the foreign tax credit, which can be taken apart or separate or together. For 2019, that amount jumps from $309,900 to $105,900. The annual exclusion for gifts. I bring this up because we get this question regularly. People always kind of forget how much is the amount of the annual exclusion for gifts. If I wanted to give a gift to my child or maybe a grandparent or somebody. So the gift is $15,000 per giftor. So for example, if I were married, my spouse and I could each give a gift of $15,000 for a total of $30,000. The annual exclusion, what it does is if you give it no more than $15,000, you're then not required to file a gift tax return or reduce your unified credit. As of January 1st, 2018, non-domiciliaries, so non-residents, are entitled also to the $15,000 exclusion. And for 2019, the exclusion for spouses is jumps to $157,000 in 2020. For 2019, it's $155,000. One thing to note here is that non-resident aliens, when it comes to gift and estate tax, it's not the residency rules that apply, it's rules of domicile. So that's why I have that term domiciliary in the slide here. You definitely want to walk through whether or not you are a domiciliary of the U.S. to determine if you get either the domicile rules or the non-domicile rules. Okay. Unified estate and gift tax lifetime exemption. So in 2019, I believe last year this was $11,400,000. In 2019, it jumps to $11,580,000 per domiciliary. For non-doms, it's $60,000. It's been that way forever. And I'll highlight that in some cases, you can use the treaty to your benefit to help with the estate tax if you're a non-US, a non-domiciled person. But very few countries have provisions that help out with that. So as you can see there, it's Australia, Austria, Denmark, France, Germany, Japan, and the United Kingdom. We'll take a pause here for our next polling question. Great, so what is the annual exclusion for gifts for one individual in the calendar year 2019? And we're getting a lot of responses here. Looks like it's pretty overwhelming. And yep, $15,000 is the correct answer. So again, the annual gift tax exclusion in calendar year 2019 is going to be $15,000 per giftor. Great. All righty. So moving on, the Secure Act, and we actually just posted a short segment I did on this related to the Secure Act. The Secure Act didn't get a lot of attention in the news. It actually probably should have gotten more attention than it did for obvious reasons. But the Secure Act was passed on December 20th, 2019, and has some significant changes for individuals that have retirement plans. And in specific, it increases the age for minimum distributions from 70 and a half to 72. And so if you were going to turn 70 and a half in calendar year 2020 and you were trying to plan those minimum distributions, you now have until the age of 72 to plan those out. So you have a little bit of additional time to really think through that and plan out those distributions. If you are still working and you are contributing to a traditional IRA, you now can make contributions past 70 and a half. That was previously not allowed, but now if you're still working and you want to make those contributions, there's really no limit. It's for as long as you're working. For inherited IRAs, there used to be stretch provisions that allowed the beneficiary to take distributions from an inherited IRA based on their single life expectancy. That has now been done away with some small exceptions. There's a 10-year max on the amount of time that you can hold those inherited IRAs before you have to liquidate them in full. So, there's a lot of folks that have done estate plans that have inherited IRA provisions in there that may need to be updated. And so if you have that, you may want to consider updating your estate plan. One other area that is, I think is kind of brand new that they're still trying to work out the details on is this adoption/qualified birth expense. And basically what this does is that if you have had a child that was born within 1 year of the bill being passed, then you can get up to $5,000 per parent to pay for expenses related to that birth. Same thing goes with an adoption. If you adopted a child, you can take out $5,000 for the adoption. There's no early penalty if you do that. So if you take it out and use it, you don't pay it back. There's no early penalty. You still have to include it in income. It can be repaid. The terms of the repayment are unknown at this time. But ultimately, if it can be repaid, then there would be no income tax on it. It would be similar to taking a loan from a retirement plan. The last item, which is not on here, which is also part of the Secure Act, relates to 529 plans. And in that specific regard, if you have a child that you're using a 529 plan to pay for their secondary education, and they also use student loans to pay for their secondary education and still have those loans, and you have money left over in the 529 plan, you can now use the 529 plan up to $10,000 from the plan to pay off those student loans. So definitely something to consider or to think about. Moving on, which is, I know, a topic we got a lot of questions about when we sent out an alert on this in, I believe, December, is FATCA, which is the Foreign Account Tax Compliance Act. The IRS basically indicated that starting on January 1st, 2020, they will be looking to receive a lot of information from foreign and offshore financial institutions, mostly banks. But within that, you have pensions, trusts, all sorts of folks. And over the next 18 months, that information will then be double checked for individuals that may not have filed the FBAR, the Form 8938. So you have information matching going on there. Folks that maybe have not provided a taxpayer identification number, what we call recalcitrant taxpayers. And those recalcitrant taxpayers could be subject to a 30% withholding on any income generated in those accounts if they have not provided the proper documentation to their foreign financial institution. So it's unknown what will happen over the next 18 months in regards to the direct results of taxpayers. For certain, we know that there will be reach out for those individuals that have not provided their taxpayer identification number. But the questions in our community are, will this increase what we call FBAR and 8938 soft letters, where the IRS is showing maybe information has been reported that doesn't match up to what was previously filed or currently filed? Will those be more commonplace, and will we have to resolve more of those issues and areas? Will recalcitrant account holders be scrutinized or put under audit? So these are some big questions that we have that we're trying to work with the IRS to determine how they're going to take their approach. Once we know more, we'll share that with our client base. What we do know, and I talked extensively with IRS personnel at the last IRS International Tax Conference, which occurs every December in Washington, D.C. But what we do know is that the IRS is heavy on what we call international campaigns. They're basically kind of telling you what they're coming after, and they're kind of telling you, like, this is what we're examining. So one of the big areas, again, is individuals that have expatriated. So if you're someone that's expatriated in calendar year 2019 or 2020, and you're filing the Form 8854, you may come under increased scrutiny. For those individuals that are filing the Forms 3520 and 3520A, you may be scrutinized a little further to make sure that everything is complete on those forms. Those forms are actually very easy to make foot faults on and to file it incomplete. So definitely making sure that it's a high caliber quality product when you send it into the IRS is important. The high income non-filers, I'm going to produce a blog post on this one, but the IRS has identified a slew of high income individuals that have not filed any tax returns, and they've created an entire unit to kind of go after these people. So that's a big topic for them in calendar year 2020. Some international organization employees may not be properly filing Form 1040-NR or associated forms, or maybe over-reporting or under-reporting certain items. And so there's a whole practice unit dedicated to the international organization community to make sure that they're doing their filings correctly and so forth. Loosely filed, it should say loosely filed Forms 5471, which are incomplete or inaccurate Forms 5471 relating to controlled foreign corporations. That's been around for a while. They continue to come after individuals that have failed to properly relay that information. And then the last one that I'll highlight on here is the virtual currency campaign. That is a big one that they're going to be putting a lot of effort into. There were a slew of updates and changes throughout 2019, and we understand that more will come in calendar year 2020. To show that the IRS has a heart, they released an amnesty program, a brand new amnesty program towards the end of 2019 for certain former citizens that have relinquished their citizenship. And so, to be clear, this doesn't apply to green card holders. It's only former citizens. So if you're a former citizen, maybe what we call an accidental American, and you've given up your citizenship, but you have failed to meet all the requirements to file with the Internal Revenue Service, this program is now available for those folks, but you have to make sure that you meet all the requirements. So it's got to be after March 18th, 2010. You can't have filed any returns with the IRS. You have to meet certain threshold requirements, like having a net worth less than $2 million, an average total tax liability less than $25,000. So these are some significant requirements that you have that are like, what you have to get over just to get into the program. If you meet those requirements though, and then file everything on the right-hand column, no penalties will be assessed, and a closing letter will actually be provided, which is not available for streamlined filing. They don't do any closing letters for that amnesty program. So all in all, it's a pretty good deal. I will highlight two things on this slide to be aware of. The first is the link on the bottom left-hand corner. If you want to read more about this, or if you have a friend or colleague that may have the situation, the link is very helpful. It walks through all the requirements and frequently asked questions. And then on the right-hand side, it should be noted that the Form 8854 is completely reformatted for 2019 going forward. So it's going to look a lot different than the previous forms, and you should pay careful attention if you are filing or going to file that form for 2019. Estimated tax payments. We get a lot of questions, especially towards the end of the year, on estimated tax payments. This seems to be an area of general confusion for a lot of people. But generally speaking, if you either owe or expect to owe more than $1,000 to the Internal Revenue Service, you need to make estimated payments for the next year. And if you don't make estimated payments, then there could be a penalty for underpayment. And so the 1040 ES, and I put on the right-hand side the worksheet that accompanies that form, is kind of the formula for how you figure out if you do need to make estimated payments and what that looks like. And I will tell folks that estimated payments are crucially important, and you should definitely pay attention to them and make your estimated payments. Which brings me to the next topic, which is the safe harbor rule. And what I really should have done was put a baseball diamond here, right? With someone sliding into the diamond, and you're safe, right? So the safe harbor rule really has three parts to it. It has a part about withholding. So if you expect to owe less than $1,000, through withholding, you're safe. If you pay 100% of your total your tax liability for the previous year by estimated payments, you're safe. If your adjusted gross income is over $150,000, then you have to up that to 110%, which is typically what we do for a lot of the folks here at the Wolf Group. You'll be safe. Or if you pay 90% of your actual liability for the current year, you're safe. Now, in 2018, the IRS actually lowered that last bullet to 85%, and there's rumors that they're going to do that again, just because of the changes to the tax rule and the withholding tables and the fact that the Form W-4 still isn't in great shape. But those are the different areas that will get you into the safe harbor. If you have questions about estimated tax payments, how to make them, when to make them, please let us know. We love working with our clients to make sure that those payments are made properly and timely. I personally do not like doing direct debits of estimated payments. I mail everything in, so I'm old school where I'll write a check and I'll go to the post office and I'll send everything certified mail return receipt. And if you wanted to do that, these are the mailing addresses and these are the typical due dates for making your estimated payments for Maryland and DC, and actually should be switched around. So again, if this is to the Internal Revenue Service, so if you live in Virginia, that's where you're going to make your payments to. If you live in Maryland and DC, that's the second address is where you're going to make your payments to. Okay, moving on. The state of Virginia. So I think I want folks to pay specific attention. If you live in the state of Virginia, there are big changes for you, or changes that you need to think about. The first is the standard deduction has increased significantly. It was $3,000 for individuals last year, now it's $4,500. It was $6,000 for married, and now it's $9,000. And I'm going to talk a little bit more about itemized versus standard deductions on the next slide, because that's of a key interest that you have to understand. The state of Virginia tax return is due at the same time as the IRS tax return, so that's April 15th. It can be extended to October 15th. I've put in a helpful link. We commonly get this question about what things are or are not included for what we call subtractions or deductions for Virginia. So Virginia has a great link that kind of goes through all the quote unquote subtractions that can kind of reduce your taxable income in Virginia. And I would tell anyone that's a taxpayer in Virginia, so take maybe 10 minutes, look through that link, figure out if any of those apply to you. That's a fantastic link that is really easy to understand. 529 plans, the deductions on 529 plans can be really great for Virginia. So you can deduct up to $4,000 for each 529 plan that you have. So for example, my wife and I, we have 2 children. One was recently born, but our first child, we have one 529 plan that my wife owns for him. We have one 529 plan that I own for him. And then jointly together, we have a 529 plan that we own together. So we have 3 529 plans for him, and we try to maximize our Virginia deductions as much as possible. Okay, moving on. The Virginia standard return versus itemized deductions. So beginning in taxable year, beginning in 2019, basically, Virginia is saying that taxpayers may claim a deduction for the actual amount of real or personal property taxes imposed by Virginia or any other taxing jurisdiction not otherwise deducted solely on account of the $10,000 annual limitation. So the $10,000 SALT cap. So what that means, if you look at this slide, you'll see that on the left-hand side, 5C has the limitation, just like federal, on last year's Schedule A for Virginia. On the right-hand side, they completely do away with that. So that's no longer in there. What this means is that you have to look, if you're someone that lives in Virginia, you have to almost think about your tax position in a total tax position, which means you actually may be in a worse off position if you take the standard deduction on your federal return, because if you do standard on federal, you have to do standard on Virginia. So what I always tell people is make sure that your CPA is running it both ways, running both standard on both returns and then itemized on both returns. And what can happen is that you may actually pay more federal taxes and less Virginia taxes, but overall your total tax, if you add both jurisdictions together, would be less if you itemized, because Virginia now has a better itemized deduction position, okay? So just to reiterate, you should make sure that whoever's doing your taxes has run it both ways and that you're giving them all of your deductions. Because if you don't give us all of your deductions, we can't run the scenario to make sure that you're getting the benefit in the state of Virginia. And I'm sure we'll get a lot of questions on that one, and hopefully I explained that correctly. I'm going to stop for a second while we do our next polling question. Okay, so what are some topics you would be interested in hearing about on a webinar? We do a lot of presentations on taxation of cryptocurrency. We also do a lot of presentations for attorneys and CPAs on foreign pensions. We do a lot of presentations on G4 and non-resident taxation with the international organizations. And then regularly we get a lot of folks that want us to present on the US exit tax. So we do a lot of those types of presentations, and obviously we can do all or some of them. So we're thinking about doing more webinars on these different topics, and it would be good to know from you all what topics that you're interested in and what things you would like to learn more about. Okay, we're getting some really good participation here. It looks like we have almost a tie between foreign pensions. Definitely is the most interesting topic, with the US exit tax slightly behind. So we'll take that into account as we move forward and we offer more webinars throughout the calendar year. Okay, state of Maryland, and we're close to wrapping up here, and I'll take a look at some of the questions that were asked and see if I can address some of those. The state of Maryland, though, the filing deadlines are the same as Virginia and for the federal return. Personal exemption amount is $3,200 with the phase out. You can see that the standard deduction is quite low for individuals and married. The state of Maryland conforms. So remember I talked earlier about conformity between the state and the federal. Well, Maryland fully conforms and has always fully conformed with the IRS. So for itemized deductions, there's full conformity there. There is a pension exclusion, old age pension exclusion. So I think Maryland and Virginia both classify themselves as great places to quote unquote retire. And the pension exclusion is part of that draw for individuals that are above the age of 65. There are no new quote-unquote subtractions available in Maryland, but they do have some updates on child care expenses, which now can be used as a subtraction and a credit. So looks like they're letting you kind of get into both categories in Maryland. Okay, next up, Maryland is, and I raise this because occasionally folks ask us why we're asking for so much information related to driver's licenses. Maryland and DC, and you'll see a later slide on this, but Maryland and DC are kind of sticklers on this. They're really trying to combat identity theft. That is a huge issue with all the taxing jurisdictions and state revenue agencies. And so it's crucially important that if you're going to be e-filing a tax return, that you send in the most updated information on your driver's license or state issued identification card. If you've recently switched over to what they call the real ID, which is in Virginia, they put that little star on the top of your driver's license, and you have an updated license, you may want to give us all of that new information. But definitely, you want to make sure to give us your driver's license information so that your return will be processed timely and that we don't have to do any follow-up with Maryland to make sure it gets in there. The District of Columbia, the Taxation Without Representation District. Okay, so DC now requires all residents to have qualifying health coverage. That is something new for 2019. For residents who are without coverage for the full calendar year, there will be penalties instituted based on your family size. So $695 for each adult, $347.50 for each child, and there are limits on what those penalties can be. So up to $2,085 per family, or 2.5% of the adjusted gross income. The return is due by April 15th and can be extended to October 15th. The standard deduction mirrors slightly the standard deduction for federal. And there's what we call the new eligible qualified high technology company capital investment tax. That is a mouthful, the QHTC. So that is applicable and will be now on the D40 for the 2019 return moving forward. Again, DC is combating identity theft. So what I would tell folks is the same thing for Maryland if you need to provide your driver's license information. But to note here, DC uses LexisNexis, which is what the IRS uses for background checks and online fraud detection. It's a commonly used software. And so what DC may have you do, so don't be surprised if you're one of the folks that get selected for this, but they may have you do what we call an identity verification quiz through their online portal to make sure that your tax return isn't part of fraud or identity theft. So if you get correspondence or notices related to this particular issue, you can let us know before you do that quiz, and we can kind of make sure that it's actually a legitimate thing. The other thing to note, and I'll raise this here, is that some folks like to have us put what we call a declaration of representation on file with your state or with the IRS. And doing so, we can't stop, it doesn't stop correspondence with you. That's statutory by law. But any correspondence you get, the Wolf Group would get a copy of. Any communications have to go to the Wolf Group first and not to you individually. So there is an additional fee to set those things up, but something that you might want to think about, especially as we move further down the line. And as you're seeing, there are all these things that may be required from you after you file your tax return. Okay. Last but not least, I have a slew of what we call helpful links. So we get this question all the time. What are the 2020 brackets going to be like? I'd like to plan for next year. I'd like to understand a little bit more about filing and payment penalties. What's the link to make my payment online? I want to pay, one of the states or the IRS. So I provided these links to kind of help you out. So if you need them for future reference, they're within the slide deck. And we'll go over questions here in a second, but I just want to make sure that my information was here. I love talking to our clients. I love answering questions when I'm available. I do a lot of presentations, so I like to schedule things. So for example, if you want to talk directly to me, my preference is that we always kind of set up a calendar appointment. It's difficult to kind of turn around something same day, but if you'd like to contact me and get on my schedule and have a conversation about something that may be affecting you related to taxes, or you have a question about the tax return or a specific form, consulting or planning services, please email me, please give me a call. Again, I'm a big fan of talking directly with all of our clients. I like to know what's going on, and I like to understand what is going on with people's world and what's affecting them, okay? So let's go over a couple things here. So any guidance, a couple questions, because we have just a little bit more time. So one of the questions states, any guidance for persons in the G4 visa filing 1040NR for their spouse's tax? That's kind of a very general question and loaded question. And so what I think the person is saying is, I'm a G4 visa holder working as a full-time employee for an international organization. My G4 spouse is also either working as an employee or maybe as a consultant. What are some things to think about? And what I would tell you is that if your spouse is working, G4 spouse is working as an employee, they're going to get a W-2, they're going to need to file the 1040NR. If they're working as a consultant, then they may be required again to file the 1040NR and Schedule C. They're not required to pay self-employment taxes, which is a common mistake a lot of taxpayers make. It's also a common mistake that the tax software will put upon the individual trying, if you're doing online like TurboTax or something like that, they'll assess self-employment tax, which is incorrect, so you end up paying more tax than you need to. One other item which affects a lot of G4 spouses or maybe G4s directly are those folks that have limited liability companies that own real property in the United States. There is a specific form that has to be filed for those types of folks in addition to their non-resident return to report the rental income. It's a disregarded entity form which requires you to file page 1 of Form 1120 and then IRS Form 5472 to report transactions between the G4 and the LLC. Failure to file the 5472 starting in calendar year 2018 is a $25,000 penalty. So it's quite significant. It's an informational form only. And so for those individuals that have those types of facts and circumstances, I would highly recommend that you get started on that. That's normally due by April 15th, but can be extended, and you have to use the proper extension forms. It's not the 4868, it's the 7004 form to extend those types of filings. Okay, next question. Does the gift tax exclusion come out of the estate tax deduction? So that's a great question. The annual gift tax exclusion, the whole purpose of it is that you don't have to report it or reduce your unified credit. So it's just an annual exclusion amount that everybody gets. As long as you stay underneath that threshold, it doesn't reduce your unified credit. So if you're doing that, your unified credit stays at 11 million or whatever it will be at the time that you pass away. Okay, next question. Is IVF considered a birth expense, a qualified birth expense? That's an unknown. They passed the law, but the way that it works, tax laws work, is that Congress passes the law and then they defer to the IRS to write the regulations. And that's really how the IRS will interpret what is or what is not what qualified birth expense. So it's uncertain whether IVF will be a qualified birth expense or not. What I would tell you is that as regulations are published, we'll make sure to post a blog post that will walk through what the IRS considers to be a qualified birth expense. My concern, though, is that the IRS generally takes a very long time to publish regulations and guidance. And if the 1 year period passes, I think a lot of people will end up missing out on the ability to take that $5,000 drawdown for those qualified expenses. So I'm hoping that the IRS recognizes that there's a 1 year limit on that and then gets out that information as soon as possible. I've read that qualified charitable contributions can be made by individuals over 70 and a half, even if they're not subject to RMD. Is this true? I'd have to understand more about this question to really give you the answer that you're looking for. I believe that the person is talking about qualified charitable contributions, perhaps within a retirement plan of some sort or not. But I would tell the person that asked that to maybe follow up with me directly and let's have a conversation about that because that's an important topic. Okay, nice question. So why do you not like direct debit payments for estimated tax? I don't like this direct debit payments for estimated tax because then the IRS has my bank account information. And that's just my personal preference. I don't like the IRS to know more about me than they need to. So I always like to send everything in via check. Once they know your details for the direct debit, it goes on what's called your master file. Every US taxpayer has a master file. And now, not only does the IRS have access to that, but every single federal agency has access to that information. Okay, it's just a general statement. Taxation of gains and losses on sales and purchases of foreign currency. So I think what the question here is related to currency gains and losses. That's a very, very specific question, whether you're an investor or you're just taking money offshore on a business trip or a vacation. So I would urge the person that asked this question maybe to follow up with me more directly to determine how the currency exchange gain or loss rules work for their specific situation. How to determine if a dividend from a foreign company is a qualified dividend? Yeah, that's a great question. So the IRS actually has a list of all the countries and if that would qualify for a qualified dividend. And it's part of a notice. I can't remember the name of the notice, but if you just Google country list for foreign qualified dividends, Google will give you that list. And it's a whole breakdown of the countries. And so if you get a dividend from that country, it's a qualified dividend. Okay. Can portfolio management fees, which I believe what she's referring to here are fees you would pay a wealth manager or advisor, be included in itemized deductions? The answer to that is no. The IRS back on the 2017 tax code eliminated the 2% miscellaneous floor. So those fees are no longer deductible on Schedule A. Now, you can deduct depending on who you're paying. So for example, we do deduct the fees that you would pay for Schedule C or Schedule E on those specific schedules in the following year because that's still a deductible expense against that type of income. But on Schedule A, the total fee is no longer deductible. Okay, which again goes to the next question, is the tax preparation fee deductible? And it is not, but again, if I'm self-employed and I'm filing a Schedule C and I paid, $200 for that fee for that schedule in 2018, I can then deduct that amount against my Schedule C gross income, okay? The last question, and I'll wrap up here, could you explain the change in the FBAR filing requirement? Did you mean that the IRS now requires a financial institution to provide information directly? If so, what is my liability if the FI does not provide the information? So the answer to that is that there's no change in anything, but what the IRS is requiring, or the US government is requiring under FATCA, is that all these foreign financial institutions report all of the information related to the FBAR. That reporting, we've been talking about that since 2011 or 2010 when the law was passed. That reporting has been deferred until calendar year 2020. So now what's happening is that the high balances or the max balances that you're reporting on the FBAR and the 8938, the IRS is finally getting that information from all these foreign financial institutions, and they'll be matching that up. And what could happen is, for example, if you reported the max value in your foreign bank account was X and your bank reported it to be Y, the IRS may come back and say, look, there's two different numbers here that are maybe significantly different, and we'd like you to clarify which one it actually is. And in some cases, if you didn't report at all, you may get audited, or the IRS may look closer at your FBAR or your 8938. In regards to what you need to provide your financial institution, it's either the Form W-9 if you're a tax resident, or the W-8-BEN if you're a non-resident. And so if you have any questions on that particular aspect, I'm happy to go more personally into that one-to-one. I do thank everybody for taking the time today. Hopefully I was clear on a lot of the points that I was trying to make. My general summary is that just like 2018, 2019 will be full of changes and things that we need to be aware of. Specific scrutiny should be given to a lot of the stuff that you're putting on the tax return to make sure you get it correct, it's accurate and complete. And we look forward to serving all of you on that 2019 tax return. Thank you very much.